How small apartment investors can diversify their portfolios. Diversification across property types. Multifamily. Focus on small apartments, duplexes, or fourplexes to balance cash flow and appreciation potential. Commercial real estate. Consider mixed-use buildings, retail spaces, or office properties for diversified income streams. Specialty real estate. Invest in niche markets like senior housing, student housing, or vacation rentals. Geographic diversification. Local markets. Spread investments across different neighborhoods within the same metropolitan area to hedge against localized risks. Regional markets. Invest in properties across different cities or states to reduce exposure to a single economic region. National international. Consider opportunities in emerging markets or stable international markets to benefit from global economic trends. Diversification through investment vehicles. Direct ownership. Acquire and manage properties directly for control and potential tax advantages. Real estate syndications. Pool resources with other investors to participate in larger, professionally managed projects. Real estate investment trusts, REITs. Invest in publicly traded REITs for liquidity and exposure to large-scale real estate portfolios. Time-based diversification acquisition. Timing. Stagger property acquisitions to spread risk across market cycles and economic conditions. Exit strategies. Plan staggered exits or refinancing to maintain liquidity and adapt to changing market dynamics. Example: creating a diversified portfolio. Scenario: a small apartment investor currently owns 2 multifamily properties in the same city and wants to diversify. The investor explores geographic diversification, acquiring a duplex in a different state with a growing job market and favorable landlord regulations. Property type diversification. Investing in a mixed-use property combining residential and retail spaces. Investment vehicle diversification, joining a real estate syndication to participate in a senior housing development. Outcome: reduced exposure to risks specific to the local economy and multifamily market. Additional income streams from commercial tenants. Lower risk concentration through partial ownership in a professionally managed asset. Benefits of portfolio diversification for small apartment investors: reduced risk. Exposure. Mitigates the impact of tenant turnover, market volatility, or property-specific issues on overall portfolio performance. Stable returns, balances gains and losses across asset types and locations, ensuring more consistent cash flow and appreciation. Enhanced growth potential, explores higher growth markets or asset types without over-reliance on any single property. Resilience during downturns. Diversification shields portfolios from severe losses during economic downturns by spreading risk across different investments. How to start diversifying your portfolio. Assess current portfolio. Identify concentrations in property types, geographic areas, or financing structures. Evaluate exposure to economic or market-specific risks. Set diversification goals. Determine the ideal mix of property types, locations, and investment vehicles to align with long-term objectives. Research opportunities. Use market analysis to identify growth areas and emerging trends. Evaluate syndication or REIT opportunities for diversification without direct management. Create a diversification plan. Gradually acquire diverse properties to avoid overextending resources. Monitor portfolio performance regularly and adjust allocations as needed. Summary: portfolio diversification is a fundamental principle for managing risk and achieving consistent returns in apartment investing. By spreading investments across property types, geographic locations, and investment vehicles, small apartment investors can reduce risk exposure, enhance portfolio resilience, and optimize returns. Incorporating diversification strategies ensures long-term stability and positions investors to capitalize on a range of market opportunities.